Today, I'll be showing you this tool and talking about how to generate consistent income in your portfolios using weekly options. But I'm going to focus our presentation today on how to generate income using covered calls. And the reason we're doing that is because covered calls is by far the most popular strategy amongst options traders. Of all the strategies that you can trade, about 45 different plus strategies that you can trade with options, about 40% of all of the volume is in that single strategy alone. And the reason for this is because covered calls is a strategy that allows you to add additional yield to your portfolio using the existing assets that you have in your account. So the stocks that you have in your account can be utilized to sell covered calls against them to add additional yield to your portfolio. It's the only strategy within options that doesn't add additional risk to your portfolio. And that's why it is by far the #1 strategy amongst options traders. So today we're going to talk about what are the best practices when it comes to selling covered calls. I'm going to talk about the fact that these types of strategies is not a one-size-fits-all. So we'll talk a little bit about what are the differences between different types of investors so that you can choose the appropriate covered calls to suit your portfolio. And this webinar today is really geared for both beginners and experienced options traders. So for those of you that are brand new to options trading, I hope this webinar inspires you to start taking a look at adding options to your portfolio. And the covered call strategy is a great place to start. So I'm just going to put the disclaimer up here for a few seconds just to let you know that trading options is risky and that anything that we're talking about here in this particular webinar is not a solicitation to trade any specific securities. Anything that we're using in terms of an example for this trade is simply just for illustrative purposes. Just hopefully you understand that when you're watching this webinar. So for those of you that have sold a covered call, hopefully you'll learn a little bit about what you should look out for when you're selecting your expirations and strike prices. And for those of you that are brand new, this is just really going to be a learning experience from the very beginning to teach you guys, #1, what is a covered call? #2, why you should use covered calls. #3, most importantly, how do you generate consistent income using this type of strategy? And then lastly, I'll talk about using options play to show you how you can instantly or quickly find your next covered call or income opportunity. Like I said, for those of you that have some experience trading options, if you're selling puts as well, this is a tool that you can use for that. The best practices that we're teaching here about covered calls apply the same way to selling cash secured puts. And lastly, what I do want to spend a few minutes on is talking about exit strategies, especially for those of you that have traded covered calls before. You've probably found yourself in the position where you've sold a call, the stock moves higher, the stock moves lower, and you're wondering what to do. So we'll talk about those scenarios and kind of how you should trade your covered calls based on the different scenarios. So I'm just going to go ahead and get started here. For those of you that are brand new, what is a covered call? It's a very simple strategy. It requires you to first have a stock position. So this is why this is the most popular strategy, because it takes the existing stocks in your portfolio, whether they're dividend paying or non-dividend paying stocks, it allows you to add additional yield to that stock by selling a call against the stock that you own. So as long as you own at least 100 shares of any stock, and that stock has options traded on it, you can potentially sell an option on the covered call, on the position that you have, to generate what's called the covered call. Okay, so it's a simple strategy where you have the existing stock position, you sell a call against it, and that generates some income. And that position is called a covered call. Why you should consider using covered calls? The main benefit of selling a covered call is that it generates consistent income. Because options expire, if you sell a 1-month option, then you can come back the following month and sell another 1-month option. You can continuously do this over and over again. And that is the income stream that you generate by selling covered calls. And in doing so, what that does is it lowers the volatility and the net cost basis of the stock that you own. So this is especially useful to lower the overall volatility of your portfolio. And if you buy a stock at $100 and you keep selling calls against it, you will effectively continuously decrease your cost basis on your stock. So this is really one of the reasons why people like to sell covered calls. And the best reason, in my opinion, is that it's used on the existing stocks in your portfolio, meaning you don't have to go out and buy anything. You don't have to add any additional risk. You don't need any additional capital to do this type of trade. whatever stocks you have in your account, you can start utilizing cover calls today with the existing stocks in your account. And that's why I think this is the most popular strategy. There is some limitations to the strategy. So it limits the upside return of the stock. So if you have a stock that's trading at $100 and you sell a 105 call against it, you're limiting the upside return of your stock above that 105 strike price. We'll talk a little bit about this in the next slides, but it is one of the limitations to selling cover calls. So it's really important to understand how you select your strike prices based on this principle. This strategy does require at least 100 shares of your stock. So if you have certain stocks that you'll have less than 100 shares of, this is not a strategy you can deploy for those stocks, only on the stocks that you have at least 100 shares of. And lastly, you do have the risk of losing that stock. So meaning you might have to sell that stock at that strike price. So for those of you that are sensitive to tax bills, or perhaps you have some stocks that you rely on the dividend for, this might not be a strategy to deploy on those specific stocks. However, I will talk about how to minimize the risk of losing your stock when you sell cover calls. So how do you generate consistent income using this strategy? How do you have a consistent income stream month after month or quarter after quarter by using this? And this is really kind of where we talk about using weekly options so to generate a consistent income stream for your portfolio. Now, before we talk about how to generate consistent income, it's really important to understand that cover calls is not a one-size-fits-all strategy, meaning if you see any screeners out there, there are people who are selling you a subscription that tells you, we'll tell you the best cover calls to sell. Don't really believe that, because each one of you has different portfolios. You have different time frames in terms of how actively you trade. You have different risk tolerances. You must adjust your cover calls to fit your personal preferences. And that's why we're going to spend most of our time on our webinar today talking about what those personal preferences are so that you can select the appropriate cover calls based on your portfolio. And what Options Play does is it actually automates that process for you. You just have to understand what your personal preferences are, and Options Play will do the rest of the work for you. So that's what we're going to walk you through today. So when it comes to selling cover calls or trading any options, there's two things that you primarily have to pick. You have to pick an expiration date for the call, and you have to pick a strike price for the cover call that you're selling. So it's all dependent on selecting a suitable expiration and strike price that will help you generate consistent income. And that's what we're going to focus on today, is what constitutes as a suitable expiration date and strike price for your portfolio. And lastly, in order to achieve consistency, you just have to use the same methodical approach cycle for each cycle. So if you're selling 1 month calls, every single month you must use the same approach every single month. And that's what Options Play will help you automate, is that piece, so that you maintain a methodical approach cycle after cycle. So talking about cover calls, there's two things that you need to select for each cover call: an expiration date and a strike price. So for those of you that have traded options before, you're probably familiar with a page that looks like this. It's an option chain, right? It has every single expiration, it has every single strike price. So you have to choose first an expiration date, then you have to pick a strike price. And if you're a cover call seller today, you probably have to do some analysis in terms of, is this enough income for me? So that typically means you have to calculate some yields or something like that. It's a very tedious and manual process. So what we want to do is show you how you can automate this. So in order to do so, we just have to first understand how to select the appropriate expiration date for you and how to select the appropriate strike price for you. So talking about expirations, that's really when we're talking about time frame. And in order to select the appropriate expirations, it really is dependent on how frequently you trade. So I have 3 buckets here. I have active traders, I have casual investors, and I have buy and hold long-term investors. So I fall under the active trader camp because I have the time to look at my portfolio pretty much on a daily basis. So I would typically choose very short-term dated options, so anywhere from 21 to 49 days out. So 3 to 7 weeks out is typically the time frame that I would look at when I'm selling a cover call. For those of you that are on the opposite end of the spectrum, so if you're a buy and hold investor and you just buy your stocks and you hang on to them for at least a few months, if not a few years, and you might look at your portfolio once a month or once a quarter, you would typically want to sell longer dated options. Because you don't have the time to look at your option positions all the time, you would want to typically do 3 to 6 month options. And then most of you may fall somewhere in between these two extremes, if you will. Maybe you look at your portfolio once a week or once every couple of weeks. You would fall in the medium term category. You would select cover calls that are anywhere from 50 to 90 days out. So before we move on, make a mental note to yourself, which one of these 3 categories do you think you fit under? And then make sure that you make a mental note to yourself, because we're going to come back to this because it's going to help you select the correct expiration for your portfolio. So now that we understand which one of these 3 you fall under, I want to give everyone an understanding as to what the difference is between these 3. So what's the difference between trading a short-dated option versus a longer-dated option? If you're going to sell a 1-month call, how does that differ from selling a 3-month call? And it really all comes down to certainty. Because when you sell a short-dated option, if you sell a 1-month option, you have a fair amount of certainty as to what's going to happen in the next month. That's not saying that you have a crystal ball. That's not saying you know exactly what will happen. But when you're looking only 1 month out, you typically have a lot more visibility. So things like earnings, things like dividends, things like product announcements, these are things that you typically know 1 month in advance. You typically know when that next earnings date or dividend, or if someone's about to launch like a new product or anything like that, you typically hear about that about 1 month out. Versus if you're selling a 3-month or 6-month call, you have a lot less certainty. So you may not know when that second earnings date is going to come. You may not know when that next earnings date is. You might not have any visibility into a product launch or anything like that when you're selling long-dated options. So you have a lot less certainty. So how does that translate into selling cover calls and the income that you receive? So the more certainty you have, the less income you receive. So when you sell a short-dated option, you're going to receive less income than if you sell a longer-dated option because of that uncertainty factor built into it. You must get paid for that uncertainty factor. So when you sell a long-dated option and there's a lot of uncertainty, you're going to get more income than if you're selling a short-dated option. You're going to get a lot less income. Okay, so now that we understand the difference between selling a long-dated option versus a short-dated option, let's take a look at historically, what have we seen the performance of these strategies have provided? Because on the surface level, you would think that, well, I would always want to sell long-dated options because I'll get more income. But that's actually not true at all. So what we've found over historical performance, and this is testing the S&P 500 stocks for the last 10 years, that it's actually much better to be on the shorter dated option, or to sell shorter dated options. And there's 2 primary reasons for this. Number one, we found that during earnings is usually the worst time to sell a cover call. That's when we have the largest underperformance of this strategy. So when you're selling short dated options, meaning if you're selling a 1 month option, you can do that 12 times a year. So we know that there's 4 earnings cycles every single year. So out of the 12, 25% of the calls that you sell will have this large uncertainty factor built into it. So only a quarter of the calls that you sell have this large uncertainty factor built into it. Versus when you sell 3-month calls, you can only do that 4 times a year. So every single call that you sell have this large uncertainty factor built into it. So 100% of the calls that you sell. So that's one of the primary reasons why we generally tell people to sell 1-month calls. And you can even avoid selling the calls during earnings, because you can still sell 8 calls throughout the year, as opposed to when you're doing 3-month calls, you really don't have that option. You have to sell during earnings, okay? So that's why we generally prefer selling shorter dated options. And this is really where you're in the weekly option. So when you're selling 3 to 7 weeks out, you're typically selling a weekly option on a stock in order to generate income. The second reason why selling shorter dated options is best for the long term is that premium is not linear to time. So I talked about selling more income versus selling a month option. However, when you sell a 3-month call, you're generally not getting 3 times the income of selling a 1-month call. Generally speaking, as a rule of thumb, when you sell a 1-month call for X, the 3-month call will only give you 2x. So if you sell a 1-month call for $1, you can't expect to get $3 for a 3-month call. You're typically only going to get $2. So what that actually means is that you can sell 2 1-month calls, collect roughly $2, and avoid selling that one call where the earnings announcement is coming out, and still receive roughly the same premium as someone who sold a 3-month call, who now has to deal with that large uncertainty factor into it. So because of those two reasons, based on historical performance, it's better to be on the shorter end of the spectrum when you're selling covered calls, okay? So now that we've covered kind of what the difference is between selling short-dated options versus longer-dated options, let's take a look at different strike prices, okay? Because that's the second piece that we have to choose when we're selling covered calls. So here I have 3 camps here. I have conservative, optimal, and I have aggressive. So conservative is referring to if you are selling covered calls and you want to make sure that you don't lose your stock. And what I mean by that is because for some of you, you may have owned the stock for a really long time. You know, maybe you bought Apple when it's trading at $10 and you've been holding on to this stock for a long time and you don't want to get rid of it because it's going to generate a huge tax bill for you. You would fall into the conservative end of the spectrum, meaning you don't want to risk losing your stock. On the other end of the spectrum, aggressive. This is for those of you that don't care about losing your stock, meaning you've purchased the stock recently or your main goal is to generate as much yield as possible. You're okay with the stock gets called away. And then most of you will probably fall somewhere in between, such as myself. I'm more of an optimal trader because I'm not too conservative. I don't have a lot of low cost basis stock. And I'm not too aggressive because I'm not here just to chase yield. So I fall under the optimal end of the spectrum. So for the expirations, I chose short term because I trade fairly actively. On risk tolerance, I choose optimal because I'm not too conservative, I'm not too aggressive. So once you make a mental note to yourself as to which one you fall under, the best way to select your strike prices is using delta or using some kind of probability indicator, because depending on volatility, you want to have one way to consistently provide you with a way to select your strikes that gives you consistency. And probability is really one of the only ways to do so. So if you're conservative, you want to select something with roughly a 10 delta call. So this is a call that roughly has a 90% chance that this call will expire worthless, which means you keep all the income and you can do it again. So this means that if you're selling cover calls over and over again, if you're selecting a 10 delta call, you should expect 9 out of those 10 calls for you to keep all that income, and 1 out of 10 calls that you sell where you end up losing the stock. So very low probability of you losing your stock. Optimal is a 20 delta call, so approximately 80% chance of expiring worthless, and aggressive, a 30 delta call, about a 70% chance of expiring worthless. So what are the differences between these 3 strikes? What does that actually mean in terms of income? So when we're selling conservative cover calls and we're selling a 10 delta call, these are strikes that are very high. So if the stock's trading at $100, you might be selling a 110 call, a call that's $10 out of the money. And what that does is it gives your stock a lot more upside. The stock needs to move $10 higher between now and expiration in order for this stock to get called away. Versus if you're very aggressive, you're going to be selling lower strikes. So on a $100 stock, you might be selling a 105 strike or a 102 strike. This gives your stock a lot less room to grow, a lot less upside before the stock gets called away. And what does that translate into in terms of income? So the lower the strike, the less upside you give your stock, the more income you're going to receive. Where you have very high strikes, where you have a lot less upside, you're going to have a lot less income for that, okay? So picking your strike prices will determine how much income you receive, and a lot of people tend to chase these aggressive calls because it gives them more income. So let's take a look at historically what has actually performed. And the answer is actually more on the conservative end of the spectrum is what performs in the long run. And the reason for this is because this strategy has a negative risk-reward ratio. What that means is that your reward is limited to the premium that you receive. So if you sell a cover call for $1, no matter what, the most amount of money you can make on that cover call is $1. However, the lost opportunity on the stock is unlimited, because if you sell a stock, if you have a $100 stock, you sell a 105 call against it, and the stock runs to $120, $130. You've lost out on all that lost opportunity because you've sold your stock at 105. And that lost opportunity is unlimited. and even though it's not a loss, it is a lost opportunity. So that's why, because the reward is limited and your lost opportunity is unlimited, you have this negative risk reward ratio. So what this means is that it's best to give your stock more upside. So letting your stock grow substantially before it gets called away gives you a better performance in the long run for your portfolio than trying to chase a few extra cents by getting very aggressive on your cover calls and limiting your stock. Because you own that stock because you think it's going to appreciate in value. You don't own that stock because you want to get rid of it near the current price. So make sure that you give your stock some room to run before it gets called away. So now that we've looked at how to pick an expiration, how to pick a strike price based on your personal preferences. So like I said, I choose short-term because I'm fairly active. I choose optimal because I'm not too conservative. I'm not too aggressive. So we've looked at how to choose an expiration date, how to choose a strike price. How do we know, are we getting enough yield? So for those of you that have traded cover calls before, what you're effectively doing is saying that, hey, I want to trade short-dated options. Here's the 30-day option. I want to trade a 10 delta call. And so let's say that 10 delta call here is the 195s, and it's telling me that it's trading at 39 cents. How do I know 39 cents is enough income? And the answer is compare the cover call yields to the dividend yield. And if you're going to ask, how do I calculate cover call yields? Options Play does that for you. So you don't have to calculate anything yourself. We do that for you. And the only rule of thumb here to have is beat the dividend yield with your cover call. Okay, so I have 3 examples here just for illustrative purposes. You have a stock that you're looking at a cover call on. It's paying a 3% dividend, a 3% yield on the cover call, and the stock pays a 1% dividend. So you've beat the dividend yield. You've tripled your yield on the stock. You only currently get 1%. Now you're getting 4%. This is kind of the scenarios that you're looking for. Here in the middle, I have a cover call that's generating a 3% yield on a stock that pays a 3% dividend. This is the bare minimum that you're looking for. So you want to at least beat the dividend yield at the very bare minimum in order to risk losing your stock. And lastly, on the example here where you have a cover call that's only paying you a 1% yield on a stock that pays you a 3% dividend. So you're only increasing your yield from 3% to 4%. That's typically not worth the risk of losing your stock. You're not getting enough yield to compensate for the risk of losing your stock. So keep that in mind. Always use the dividend yield to help you gauge, am I getting enough yield? So with all of this, what we find is that when you're choosing expirations based on all the historical backtesting, it's best to prioritize certainty, meaning understanding what's going to happen between now and expiration over premium. That's going to give you better results in the long run. And when you're choosing strikes, make sure you prioritize upside return, giving your stock that room to grow, because that's why you own the stock. You think the stock's going to appreciate in value. So make sure you give that room to grow versus prioritizing over large income by selling a very aggressive strike. And with that, based on all the backtesting results that we've seen, we found that the optimal expiration is really on the shorter end of the spectrum, so 21 to 49 days out. You do have quite a bit of leeway there. So even if you're not very active with your trading, you can still sell a 7-week call and still be in the shorter term category, and you're still going to be able to reap the benefits of selling shorter dated options. And then strike prices, we found that the strike prices that give you the best risk reward in the long run are strikes that are somewhere between optimal and conservative, roughly a 15 delta call. So calls that have roughly an 85% chance of those calls expiring worthless. And with that, what we've seen is the average performance is an annualized return of about 3.4% above the existing stock return. So this is based on the average annualized return on a cover call using the S&P 500 stocks over the last 10 years. So these are the type of average returns that you'll expect. Again, these are average, which means that depending on the stock that you have, some may be high, some may be low. This is the average performance that we're seeing across the S&P 500 stocks. So with that, let's start actually showing you some real examples. So you've listened to me talk about choosing an expiration date, choosing a strike price, how those affect you, and then using the dividend yield as your guide. Let's actually show you some real examples. So in order to launch Options Play, which is a free tool available, so once you're done with this, I highly recommend you to start taking a look at this. You can find it under the Options Trading tab. There's a button here on the right that says Options Wizard, and what that offers you is Options Play. So when you click on that, it brings up this page. So this is a full trading platform that's designed to help you with all your option strategies. It'll also even provide you with stock trading ideas. It'll provide you with a watch list so you can set up and look at the different sectors and drill down into the different sectors. It will provide analytics on the underlying stock so that you can quickly identify, the strength of the stock, relative strength. So a technical score of 8 here tells me Apple's very strong. It tells me the 1 month and 6 month trends are bullish. So not only is it strong, it's continuing to trend higher. Provides me with very important information such as earnings, dividends, and price action so that I understand where the next earnings date is, when the next dividend is, when the next price action is, what the current price action is. And then once I have all that information, I can click on I'm bullish to be presented with 3 bullish strategies on Apple. You can click on I'm bearish and be presented with 3 bearish strategies, and a bunch of different tools that's designed to help you understand how each strategy performs based on your given outlook for the stock. So if Apple's trading at 178, you think it's going to trade down to 170. It'll tell you what the expected return of each stock, each strategy is, so that you can make comparisons side by side. And if you decide on a trade that you want to make, you can click on the trade button, preview order, and that will send the ticket back to Firstrade so that you can execute this trade. However, today, that's not what we're going to be focusing on. We're going to be focusing on income. Again, income is by far the most popular strategy. This is where many of you, if you're starting out with options, will probably start. So I highly recommend you to go to the income tab. And once you click on the income tab, there's going to be a button at the bottom that says income settings. This is where you want to start, especially if you're brand new. We talked about selecting an expiration and selecting a strike price. So we talked about short, medium, and long term based on how actively you trade. So I choose short term because I'm fairly active. You should choose the time frame that best suits your personal preferences based on how actively you trade. And then risk tolerance should be also based on your personal risk tolerance. So are you conservative, meaning you want to minimize the risk of losing your stock? Are you aggressive because you're looking to maximize the yield of the covered calls? Or are you selecting optimal because you're somewhere in between? Make sure that you select the appropriate time frame and risk tolerance that based on your portfolio so that everything that we show you will be based on your personal preferences. And again, just real quick, for those of you that sell puts, you can use this for the same thing. You can select your suited time frame and risk tolerance for puts. So for me, I'm still on the short term because of how actively I trade, but I like to be a bit more aggressive when I'm selling my puts. I want some additional yield when I'm selling puts. So you can set these two independently of each other. Once you do so, you click on Save as Default, and every single symbol that you type in, and I just created a cover call watch list here, and I highly recommend if you're selling covered calls, put a watch list together with all the stocks that you own. It's going to make your life a lot easier because you can just simply click on a stock and we will instantly go out and search for the covered call based on your personal preferences. So here's Bristol Myers. It's trading at 52.38. This is telling you that it'll ask you, do you own shares of Bristol Myers? You can enter the number of shares. So let's say you own 200 shares of Bristol Myers. It will tell you that you can sell 2 contracts of the May 11th 56 cover calls. So notice how you don't have to pull up an option chain. You don't have to go through here and click on option chain, type in Bristol Myers. Then you have to search for the 30-day option. So you'll look at the 30-day option. Then you have to find what's the 10 delta call here. It does all of that work for you. You just have to click on the symbol and instantly tells you to look at the May 11th 56 cover calls. So for those of you that are brand new and you're not quite familiar with this strategy, it'll tell you, it'll explain it to you in plain English. It'll tell you selling the May 11th 56 calls will generate $94 in premium. It'll produce a 13.6% annualized return and an 81% chance of expiring worthless. So we talked about selecting, number one, a cover call that's short-term. So this is 24 days out, so right in that sweet spot between 21 to 49 days out. It selects a cover call that has an 81% chance of expiring worthless, which is right around that 80% target that I'm looking for as an optimal trader. So it does all of that work for you. It goes out, finds the right expiration, finds the right strike price, and displays to you the yield. So Bristol Myers, if you own the stock right now, you're getting paid roughly a 3% dividend yield. However, by adding a cover call, you can increase that yield another 13.5%, which brings your total 12-month projected yield to roughly 16%. So this is exactly why this is the type of strategy that's most popular with traders who are starting out, because it allows you to add additional yield to your portfolio without adding additional risk. And it's a relatively easy strategy to start with. And you can do this for any stock that you own in your portfolio. I can click on a single stock. I never have to pull up an option chain again. If you're brand new, this is designed to help you, provide you with a starting point so that you can start analyzing, start learning, start paying attention to these trades. And for those of you that are already trading cover calls, this shaves your research down from a few minutes down to just literally 5 seconds. So now I'm looking at Goldman Sachs trading at 253. This is telling me to look at the May 11th, 267.5 cover call, so roughly $13 out of the money in the next 24 days. It tells me my yield, 7.8% on a stock that only pays a 1% dividend yield. So I'm increasing my yield from a roughly a little over 1% to almost 9% by selling cover calls on top of it. These are the type of trades that you want to look out for. If you own AT&T, trading at $35 right now, this is telling me to look at the May 11th 37 cover call, so about $1.50 out of the money. It tells me the yield on this call is 10.75% on a stock that pays a really nice dividend of 5.5%. So if you own AT&T, you are getting a really nice dividend already, but you can increase it another 10% by selling cover calls on top of it. Same thing with Walmart. And as you can see, as I go through this, you can see how easy this becomes. You no longer have to feel that you're confused by which option to choose off of an option chain. And then once you pick the strike, then you have to calculate some yields in your head. You can either do it roughly on the back of an envelope, or you can enter it into a calculator. Either way, it's going to take you quite a bit of time to not only find the option, calculate the yield, and decide, is this enough income to risk me losing the stock. But this does all of that for you in just a few seconds. And once you've identified a trade that you want to make, so let's say we're looking at Walmart here, you can enter the number of shares you own. So let's say you own 300 shares of Walmart. It'll tell you exactly how much income you receive, $108 in premium over the next 24 days, 76% chance of this expiring worthless. So if you're looking at this trade and you're saying, this is a trade that I'd like to make in my account, one of the things that we've done with Firstrade is that all you have to do is click on the trade button. For those of you that are brand new, I highly recommend you to take a look at our strategy checklist. But if you're looking at this trade, all you have to do is hit the preview order button, and what it does is it pre-fills the ticket for you. So you never have to pull up an option chain. You don't have to enter all of these things manually. It selects the expiration date, selects the strike price, tells you the current bid ask, and you can simply enter a limit order, a market order, however you want, and simply send that order instantly. You don't have to fill out any tickets manually anymore. So that's really one of the best things that we've done with our integration with Firstrade, is to provide you with not only the instant idea, but the ability to execute this trade immediately into your account within a few seconds. So as you can see, I can go through a watch list very, very quickly. Let's go back to my cover call watch list, and within a few seconds go down a list of 20, 30, 40 stocks and know instantly which stocks have cover call opportunities, like Johnson & Johnson. It not only tells me that there's an opportunity because it provides me with that green check mark, it also tells me exactly which cover call to look at and what the yield is, so I can quickly do an analysis and say, is this enough yield for me to sell this cover call on? And the one thing that I will point out is a lot of times when we're selling cover calls, you might end up typing in a stock, looking at the different expirations, looking at the different strike prices. And as you can see here on Ford, it's trading at $11.38. Once I get to the $12, $13, at the $13 level, it's only trading at 1 cent. So there's almost virtually no income here to be made on Ford. So what you end up doing is you pull up a chain, you search for it, and then you realize there's not enough income. One of the things that we do here is we actually scan for that, and if there's not enough income on it, we'll tell you. You don't have to go wasting your time. So it tells you based on currently available options on Ford, we could not find a call to sell. And as you can see, if you had done the manual work, you would have came to that same realization, but you would have to pull up the chain, go through the different expirations, and then realize there's just not enough premium in this stock to sell covered calls against this. What we do here is we do all of that work for you, and if there's not enough income, you see it instantly based on the message that we show you. And you can simply go through a list very, very, very quickly and know exactly, number one, what your starting point is. So again, for those of you that are beginners, it helps provide you with a better starting point than showing you a page like this. And for those of you that are currently trading covered calls, this will save you a lot of time from doing research and trying to figure out what is the right expiration strike price. And not only that, because you've chosen your income settings and you don't have to touch them once you've created those settings, this allows you to generate consistent income because it's constantly choosing a covered call that has the same probability of expiring worthless month after month, quarter after quarter, so that you always find calls that have roughly the same probability of expiring worthless. And that's how you generate consistent income in your portfolios. And I can't stress that enough. When you sign up for Options Play, or it's, when you come into Options Play, it's free of charge to you as a Firstrade customer. Set up your watch list. Just put all the stocks that you own in your watch list, and then come into the income tab, create your settings, and that will allow you to start playing around with where is your starting point and start looking at research ideas. And I'm just going to spend 2 minutes in talking about, for those of you that are selling puts, you can always click on no if you don't own shares of Visa, and it will give you a put selling opportunity. This is for those of you that are a bit more advanced. This is an alternative way to potentially own this stock as opposed to just currently buying the outright price. You can sell the May 11th 120 put for $149. As you can see, this is an 18% yield. Now, I chose an aggressive cover call track because I like to get aggressive when I'm selling cover calls. So this gives me a very substantial yield of roughly 1% of the underlying price over the next 24 days just to sell a cover call, or essentially trying to enter an order to buy the stock at 120. I think 123 is too high. I'll buy it at 120. In order for doing so, I'm going to receive $149 in income. So that's how you use our tool for selling puts, if that's something that you're interested in. So with that, I'm just going to go right back to talking about, for those of you that have sold covered calls, what are some of the exit strategies that you can deploy? So number one, you can, the three scenarios that you'll come across when you sell a covered call is, number one, the stock may shoot higher above your strike price. Number two, the stock kind of trades sideways. Number three, the stock drops drops after you sell your cover calls. So the first one is really where most people tend to panic. So if you sell a cover call, let's say you have a $100 stock, you sell a 105 call, and next thing you know, the stock's trading at 110. This is where we see a lot of people panic because they're not sure what to do. And the answer here is, don't panic. Make sure you hold your position and only roll it if you need to, meaning sell another cover call only in the last week of expiration if you have to. And the reason for this is because if you roll early, you're going to lock in that loss. You never want to lock in that loss, and you're not capturing the time premium, which is the whole point of selling cover calls. So if you're going to sell a cover call, make sure you capture that time premium, let the stock potentially have time to come back below your strike price, and if you need to roll it when the strike price is hit about a 90 delta, that means the stock has to make an extreme move higher. And if it kind of hits that point, that might be time just to cut your losses, get out. And it's not really losses because you don't have a real loss on the trade, because whatever losses you have on the call, you actually gain back on the stock itself. So this is why this is considered a strategy that doesn't add an additional risk to your portfolio. The second scenario is when the stock goes sideways. So if you sell, you have a $100 stock, you sell a 105 call, and the stock just goes sideways and continues going around $100. That's where you want to simply hold this position until expiration, let the call expire worthless, and come back the following Monday and sell another cover call. That's kind of your best case scenario when it comes to selling your cover call. And lastly, if you sell that 105 strike on a $100 stock and the stock plummets down to $95 or $90, this is the only time where it makes sense to roll your position early, meaning before expiration or well before expiration. And the rule of thumb here is that if you can buy back a call that you've sold for less than 20% of the premium that you've originally sold it for, that's a good time to take profit. So if you sold the 105 call for $1 and you can buy it back for 20 cents or less, now would be a time to consider taking profits and selling another cover call. So those are the three scenarios that you'll typically come across when you're selling a cover call, how to handle them. And that is in short kind of the presentation that I have for you here today. So just to recap, if for those of you that are selling covered calls, make sure you set up a watch list with the stocks that you own. Come into the income tab here. Make sure you select the income settings based on your personal preferences and save as default. Once you do that, everything that we show you in terms of a covered call and short put opportunity will be based on your personal preferences. So this is designed to help you, again, for those of you that are beginners, helping you inspire you to start exploring and taking a look. And for those of you that are currently trading, I really hope this saves you a lot of time, because I know this has certainly saved me a ton of time when I'm selling my covered calls. And once you're ready to do that, make sure you hit the trade button. Go through the strategy checklist if you're brand new to make sure you understand your risks. And lastly, preview order so that you can enter your ticket into your Firstrade account. So with that, what I'll do is I'll open this up for Q&A. Any questions you have, please type in this in the chat window. I think there's a couple of other questions that are already in. I'll try to address them while anyone else types in their questions. One of the questions here is, will you be discussing leaps and cover calls? And I'll talk about that real quick. So a lot of people have come to me, saying, I don't have enough money to buy 100 shares of Microsoft. How can I still generate some cover calls? So what you can do is, if you don't own 100 shares of stock, which costs you $9,600, you can buy a leap. You can buy a deep in the money leap. So for example, if we look at a leap here, let's take a look at January 2019, and let's say we buy at $90 a call. These two strategies are very, very similar. Maybe we can even go a little deeper. Let's say we do an 85. So these two strategies are very, very similar in terms of risk profile. You have unlimited gains to the upside. You actually have limited losses to the downside. So if the stock goes below 85, your losses is limited to $1,500. But notice how it only costs you $1,500 to get similar exposure to owning the stock. So this is what we call a poor man's cover call. So you don't own 100 shares of the stock. You can buy this leap here for $1,500 as opposed to $9,600, and you can sell covered calls against this leap. So that is one way that you can take advantage of this strategy, even if you don't own 100 shares of that stock. I just want to thank everyone for taking the time out this afternoon for listening to this webinar. We designed this webinar specifically to help beginners to kind of get started with options and feel that you don't have to be boggled down by all those option chains, so that you feel that you have a tool that helps you start the learning process and help you navigate options without necessarily feeling overwhelmed by all the data that's sometimes given to you when you're starting out with options trading. So I really hope that achieved that at the very least. And thank you for all the people who have said, thanks for the presentation. I really appreciate you guys taking the time out this afternoon to listen to this. I hope you guys find this tool useful. Again, for those of you that have not used this tool, you can find it under the options trading tab. It is under the, once you click on the options trading tab, you'll see a button here that says options wizard. When you click on that, that will launch options play. I highly recommend you to log on, take a look. Even if you're not ready to trade your option, you just want to take a look and start exploring and learning. That's really why we built this platform. So please log on, take a look. And if you have any questions, feel free to send us your feedback.